Okay, hello everyone. It's nice to see you guys all here. And I believe that it's 1 p.m. now, and I hope you guys have a good lunch earlier. Well, after about I think few months ago, probably you have already seen me before in another webinar where we FSM1 team we also present our view and some of our insights about the budget 2023. But since then, you know that a lot of political development, a lot of soap drama, here and there. Then yet last Friday we have finally come with our revised budget 2023, which announced by our new PM as well as his finance minister, Anwar Ibrahim as well. So today is glad that FSM1 having us, me and my colleague Elvin. So Elvin, you introduce yourself.
I'm Elvin from the FSMR research team, and really nice to see all of you here. I know it's hard to believe that we have yet another budget already. It's just 5 months ago. So yeah, hard to believe it.
Yeah, okay, so without further ado, let's just start our presentation. But way before that, I want to give you some insight, which is if you stay until the end of our presentation, we FSM1, we are very generous. We are giving you a giveaway, which amount up to 100 ringgit. So if you want to know more, stay tuned to our last part of our presentation. So yeah, without further ado, let's just go to a very quick recap of what happened year to date. January is a good year compared to a lot of bad things happened last year. And year to date wise, you can see that a lot of developed market, the CSI was 300, S&P stocks we represent by the EU market, they have all recorded quite a decent performance, I would say. And also our FEM small cap, which majorly are small cap in Malaysia, they are also deliver quite a significant performance. While on the other hand, the ASEAN, our country, which is FBN KLCI, has just registered a negative 2.6%. So I would say that it's not really satisfying because a lot of foreign investors they are very eager. They want to know that what is the outcome from our budget 2023. So that's why we see there are a lot of foreign outflow, especially in the recent weeks. Well, year to date wise, the sector performance, you can see that most of the traditional stocks like plantation, financial, and also industrial, they all delivered a positive performance. Well, on the other hand, the healthcare sector, which is unlike last year, last year the healthcare sector more or less they are glove stock, but this year around the healthcare sector, actually most of them are built by the pharmaceutical and also the hospital sector. So yeah, similarly, they also delivered a positive return. Why? Because a lot of investors, they are starting to look at this kind of value counters to amidst this market volatility. So yeah, actually from this slide, you can see that what has happened during the last Friday. So actually this chart is just showing the FBM KLCI intraday performance. Well, I know that until today, actually after 2 days, they have slightly come down a little bit due to the regional market underperformance. But overall, during the budget day, so you can see that actually the market not react very aggressively. I would say the reaction is kind of mild. So yeah, our equity market reacted the reaction is quite muted. I mean, because of the budget is not really giving us surprise. Well, on the other hand, the bond market, which actually you can see from this line, the blue color line, I mean the line is showing that the budget day, and also the table on the right hand side is just also showing you what happened for the bond market. So you can see that the daily change, which on the right hand side, the basis point is just 1 or 2 or -1. It means that actually the bond market also treat that this budget quite just normal day for them, I would say. Yeah, without further ado, let us move to our main topic today, which is what our takes from all these this policies announcement. So at a glance, you can see that the budget size 388.1 billion ringgit is the highest amount ever. And you can see that compared to the previous one, 372, which is already one of the highest amount last time, it has simply exceeded the number. And also the operating expenditure is one of the highest, and development 99 billion ringgit Malaysia, also the highest. So this time around, because of the normalizing crude oil prices, and also after the post-pandemic reopening, last year Malaysia have recorded quite a very, very good GDP growth, thanks to our post-pandemic reopening and also the surprising crude oil prices. So that's why we have delivered a fairly good GDP growth. However, come to this year, we think that normalization is almost here. So that's why, according to our PM, he announced that our projected GDP growth in 2023 will be 4.5%. Meanwhile, a good news, which is our fiscal deficit, he's targeting at 5% compared to the previous one, 5.5%, which I think is a good news, especially for fixed income. And my colleague Alvin, he will give some insights later. And last but not the least, inflation rate. He's targeting at 3.3%. Why? Because a lot of subsidies and also Malaysia as a commodity exporters, we are kind of benefit from that. And compared to other developed regions, actually we are giving a better performance in terms of economic. Well, for the budget 2023, this is just a slightly in-depth view. So you can see that this is the largest ever national budget in history. And on the chart on the right-hand side, actually you can see that from 2023, similarly, operating expenditure is the biggest portion, and also development expenditure is only comprised of 25%. While this time around, what's different compared to last time, which we already don't have the COVID-19 fund, which means that our government has already giving a signal that we are out of COVID and normalization are just near to us. Well, next slide. You can see that our operating budget is one of the highest, and also the operating expenditure by component, actually more or less compared to last time is more or less the same. While a lot of fixed charges like retirement charges, emolument, subsidies, yeah, all these are fixed charges. So if you ask me what's my thoughts from this operating expenditure, I would say that it gave me no surprise, because it has been a legacy issue, especially in Malaysia. We are always facing the higher operating expenditure throughout the years. So actually for this time, I would think that this operating expenditure is a good news for me. At least it giving us some insight that we are gradually decreasing the debt service charge and also retirement charges. Well, for development expenditure, what I want to show you here is you look at the slide on the right hand side. Okay, so you can see that the economy have delivered a very significant growth, which I think that is a positive news for development expenditure, because Malaysia, throughout the years, we have always been lack of this kind of development expenditure to give a huge catalyst to boost our economy. While on the other hand, one bad news for this development expenditure is the PM has also announced that one of our debt burden, which is 1 MDB debt repayment, are also allocated to this development expenditure, which is about 12 billion. So if you calculate from the 97 billion of the development expenditure, you deduct by about 12 billion. So it only gives you about 75 billion ringgit Malaysia, which is actually lower compared to last time the development expenditure, which is 95 billion ringgit Malaysia. Well, another good news, which is compared to last time, actually our income stream from the commodity, which is petroleum, Malaysia has always been a beneficiary of the soaring commodity prices, especially crude oil. Well, actually from this time, you can see from the slide on the left hand side, throughout the years, since 2009, 2010, actually we are already gradually decreasing our dependence on the petroleum prices, and our non-petroleum prices is starting to rise throughout the years. So it's a good news for us. And also, last but not the least, the budget deficit is narrowing, as you can see from the slide on the right hand side. So what I always mention about the budget deficit actually is crucial, especially for the fixed income investors, and my colleague will take over on the next part. Kevin.
Thanks, Kevin, for giving us a brief look on what are some of the things that the key highlights that from the newly retabled budget. So now I would like to go deeper into the impact on the fixed income side from this budget, the newly retabled budget. So I see that there's no very significant changes to the new budget, and only some adjustments to realign the some of the objectives as well as principles to the Malaysian Madani framework. So So for this, I would like to break it down into both two aspects in the fixed income side, which is firstly the corporate aspect. But the corporate aspect, I would like to leave it to you to discuss on it afterwards, because on the corporate aspect, it is more related to the sectors that the companies that it is in, as well as the sectors as well as the fundamentals of the company. So for me, I will dive deeper into the government aspect. So for government aspects, as you can see from this chart over here, the next. Okay, so from this chart over here, you can clearly see that first we'll look into the fiscal deficit, which is set to improve in 2023. So you can see that from this chart here, the goal of the government is to first to boost consumption, as well as second is to reduce the fiscal deficit that has been ballooning during the pandemic. So you can see that the newly retabled budget has a higher expenditure compared to the previous one that is announced during the October of 2022. But then the fiscal deficit is actually improving from negative 5.5% to negative 5% for the newly retabled budget. So how can it be done when the expenditure is actually increasing? So here comes the the revenue from the government. So actually the government revenue is set to improve also in the newly retabled budget because of the newly introduced tax, such as the luxury tax, as well the excise tax, as well as some of the changes towards the taxation system, which increases the tax by 2% for those high income earners that has more than 100,000 income for annual income, while reduces the taxation income by 2% for those who earns 35 to 100,000. So basically, the government is trying to tax the rich and reduces the tax burden for those mid to low income earners. So let's look at the other aspect. That is another important aspect, which is the national debt of our government. So we can see that from the chart in your left-hand side, right? The Malaysian national debt is set to hit 1.2 trillion Malaysian ringgit in 2023, and it is around 60% of the total GDP. And we look at this chart, it is comparing the debt to GDP ratio among ASEAN peers. You can see that Malaysia actually has one of the highest debt to GDP ratio among ASEAN peers. We need to ignore Singapore because Singapore is at a completely different league. It is one of the 11 countries in the entire world who has a sovereign credit rating of AAA. So, and then also they have very less net government debt, as well as very less debt servicing costs. So if we strip that out, we can see that Malaysia has almost one of the highest debt to GDP ratio among ASEAN peers. So although it may look a bit concerning, but we don't think that this issue is worrisome because of first, the Malaysia debt servicing ratio to the revenue is actually around 15%. That means that each ringgit that Malaysia government generates, they use 15 cents to pay for debt. And if we compare it to the one of the latest government that defaulted on their debt was Sri Lanka, who has a debt to service ratio of around 70% of their revenue. That means that they are actually paying 70 cents for each unit they earn to service their debt. So when we look back at Malaysia, we are quite optimistic on the government's debt servicing ability, and and we don't foresee any possibility of default in the near term. So in all, we think that all of this, especially the reduction on the fiscal deficit, will be beneficiary to the Malaysia fixed income market because of the large fiscal deficit has been concerning to a lot of global credit rating agencies. And so the improvement in the budget 2023 will definitely be a boost towards investors' confidence as well as the domestic fixed income market. So next, let's move on to the outlook for the fixed income market. So We are quite optimistic on the local fixed income market in 2023, and we think that it is time to embrace income as bonds has been trading at very, very attractive levels for a while already. So before we start, dive deeper into the outlook. Let's have a quick recap of 2022. As most investors are already aware, 2022 has been a year like none other. Starting from the Russia-Ukraine war to persistently high inflation and then to rampant interest rates, which caused central banks all around the world to hike their interest rate up to decade high levels. And the result was a tempest, as it is the first year that both the US stocks as well as US bonds were both down more than 10% in the past 150 years. So bond yields spike up insanely while the bond prices experienced huge sell-off. And then while all of this happened, one of the market, which is Malaysia, actually we will remain quite resilient, and as we outperform the global equities as well as global peers. So as you can see from this chart over here, while all other indexes were down more than 10% in 2022, the Malaysia bond index actually they did quite well. As you can see on the top side, the indexes that is on the green positive area as first the corporate bond, Malaysia corporate bond, next Malaysia government bond, and then next Malaysia bond index, which include Malaysia corporate bond as well as Malaysia government bond. So entering into the year 2023, right, we already see that it is started with continue to rise with headwinds, continued global inflationary pressure, slower economic growth, and global recessionary fears. So we think that 2023 looks like going to be another volatile year. That's why you need the Malaysia fixed income who can deliver very stable returns to your portfolio. So next, as I mentioned, the Malaysia century bonds remain resilient as they outperform global peers as well as compared to global equities. When you see it from the chart on your left hand side, right, you can see that actually Malaysia bonds were quite stable in 2022 despite market volatility. As you can see, the blue line there is the Malaysia bond market. The Malaysia bond market as measured by the S&P, while the other lines were MSCI World Index as well as MSCI Asia X Japan Index. So you can see that the Malaysia bond market actually they perform quite well as compared to the equities as well as its peers. So it remains quite relatively stable despite market volatility, despite all of those negativity in the market. Why is this happening? It's because of decent run for the fixed income amid huge domestic liquidity. So as you can see from the chart on your right hand side, it shows the inflow or outflow into the domestic government debt by buyer as of the third quarter of 2022. So we don't have the data yet for the fourth quarter of 2022 because it hasn't been released yet. So we will look into the third quarter. It's a cumulative result. So you can see that despite the sell-off from the non-banking institution, we saw huge inflow from local players such as the banking institutions as well as the EPF to support the Malaysia fixed income market. So you can see that actually the bond prices didn't fall as much as other countries. So next, we can see that why we think that yields are also trading at very attractive levels, as we think that the current bond yields have already priced in sufficient rate hike buffers. So why would I say that? It's because of when you look at this chart, how do we decipher this chart is that looking at the orange line represents the Malaysia 5-year bond yield, while the blue line represents the Malaysia OPR rate, with which is the Malaysia interest rate. So when you looking at the history, right, in the past, right, you can see that the orange line is actually trading quite relatively closer to the blue line, and since 2022, all of those macro uncertainties such as the Russia-Ukraine war, the global inflationary pressure, hiking interest rates, and also all those and also COVID-19, right? It has caused the yields to react upfront of the interest rate. So you can see that the gap, the spread between the yields as well as the OPR rate actually widened by a huge margin. So why would I say this is attractive is that because when you look at where we are now currently, we are now trading at the yields is around 3 point something percent, near to 3.5% for the 5-year bonds. But actually, in the past when we are trading at this kind of level, right, the OPR rate is at around 3 to 3.25%. So, but currently we are at around 2.75%. Means that actually the yields have reacted more upfront, and they are actually pricing in more hikes already. So even if the Bank Negara Malaysia decided to throw us a 25 or 50 basis point hike in the coming MPC meeting, we think that it wouldn't affect bring a huge sell-off in the Malaysia bond prices. So in all, we think that the Malaysia fixed income market remains very, very attractive for investors because first, we think that it's very stable, and then it's trading at very attractive yields, and then it is supported by a lot of huge domestic players. So yeah, that's all. That's pretty much sums up my fixed income outlook for 2023. So going back to the budget 2023, right? Comparing it to the previous budget that was announced in October 2022, what surprises you the most, Kevin?
Actually, if you ask me what surprises the most, as actually I mentioned just now, actually nothing surprised me. Okay, well, move to the budget highlight this time around, right? You can see that it's quite a good, it's a nice design thanks to our design team that published earlier about what's the budget highlight. And you can, if you want to know more, you want to have more detail for it, feel free to launch to our FSMR website. We do publish this budget highlight on it. Well, from this, in this presentation, what I want to emphasize here is if you look at it, actually, like what I mentioned just now, you ask me what are the biggest surprise, I would say that the biggest surprise for me is no surprise. So why I say so, unlike last year, the government has announced a prosperity tax as known as Cukai Makmur, which hamper a lot of big boys, a lot of large cap companies, banks, telco, plantation, those big boys, they really negatively impacted a lot. But this year around, it's glad that the government, they didn't announce about this. And what they have announced, they announced luxury gain tax and also the capital gain tax for the unlisted shares. While on the other hand, similarly, like what the previous budget, the government has also tons of good news for SME and also the lower income group, which is known as B40 and M40. While the budget this time actually is not a very friendly budget to the rich. That's why you see that the topic, the blue color font out there, what my topic is taxing the rich. If you look at the income tax statement from on the left hand side, you can see that the top group, I mean from the maximum cap at 100K. So you can see that there are those income group, they have income tax deduction. While for those who have who are categorized under the higher income group, they need to pay more tax. So actually, it's good news that for this time the government didn't announce the goods and service tax, the prosperity tax, and also the global minimum tax, like what a lot of external parties have anticipated. Well, so they have announced this luxury goods tax and also a capital gain tax. So if you ask me what are the impact for these two tax to the market, especially the equity market, I would say that as for today, actually the government hasn't disclosed a lot of information about this. So we don't have a very exact number about how these taxes will impact. But if you ask me personally, I would say that, yeah, the luxury goods tax definitely in the short term, it will more or less impact how the people spending habits, especially it's a bad news for me if I want to buy something to my girlfriend, So it's a bad news for me, especially when someone wants to buy luxury goods tax. That's why when look from a market perspective, we are holding a slightly neutral view for the consumer discretionary sector, which because due to a recession fear and of course this kind of taxes, it will more or less impact this kind of consumer discretionary sector, sector. Well, this is just a very quick glance that who are the winners and who are the losers in this budget. So in overall, I would say that the biggest losers in this budget is a Sin stock. I'm pretty sure that this announcement is very unfriendly to those e-cigarettes producer. Like why? Because the government has announced the excise duty imposed on the e-cigarettes like liquid nicotine, these related products. So we think that actually the announcement, if you ask me about the impact to some of the companies, let's say one of the big boys in Malaysia, BAT. If you ask me what are the impact of this announcement to BAT, I would say that the impact wouldn't be very significant, at least in the short term. However, in the long term, we see that actually this is not the first time that the government has always emphasized they want to push and for a healthy community. That's why we think that this is just a start, especially for the government to introduce this kind of healthier community, and probably the next going to be the those since stock related companies like number forecast agencies and also alcohol companies. Meanwhile, for the winners, we see that the construction is a winner because a lot of budget, a lot of like development expenditure has been allocated to infrastructure project, especially East Malaysia, South Malaysia, a lot of schools, highways, and also those social infrastructure. Meanwhile, the consumer, so the budget this time around, as I mentioned, a lot of times already, the budget that Anwar has always emphasizing to maintain the fiscal discipline while providing a buffer, especially for people who are categorized under the lower income group. That's why they are taxing the rich and using the money from there to provide subsidies to the consumer. So as of today, actually, we don't see a lot of news from the government about that they are going to rationalize the subsidies given, especially for the food and fuel. But as of today, especially last day when I read the news on The Age, I noticed one of the news is that the government has announced they want to maintain the price ceiling for eggs, which is one of the poultry product. And I think that it's a good start for the government, because you can see that they want to control the line for the consumer staples goods. Well, last but not the least, the SME has always been always been a honey for our government. So you can see the range of supportive measures like tax deduction, like they provide incentives for them, and these all are allocated to the backbone of Malaysian economy. So in terms of equity, if you ask me what are the impact from the SME, I would say that the direct impact is very minimal. However, the indirect impact is a crucial one, because you need to know, no matter what are the big boys, I mean those companies, those listed companies are doing, they need a very matured supply chain, which most of the supply chain are come from this SME. So it's a benefit, although it's not a very direct one, but it's an indirect benefit for the for the listed companies. Well, I know this slide is a slightly tedious slide, and I wouldn't want to go through it very in depth one by one. So if you want to know more, feel free to ask us in the Q&A session, and me and my colleague Elvin are very lovely to answer all the questions. So for this time around, actually you can see that from the view, most of the sectors the reaction, I mean our insights for how the budget will impact these sectors are more or less positive or even neutral. So what I want to emphasize here, like construction and consumer, I have already stated it earlier. While for the financial, that are always been a big boys, especially in FB and KLCI, which has about 30% of weightage there. So in this budget, actually, they don't have a very direct impact from budget, unlike last time because of prosperity tax. But we still hold a positive view towards this sector. Why? Because we think that the rejuvenating economy will be beneficiary, especially you can see that the government has the incentive to boost the MSFE growth. When the SME is growing, definitely they want to achieve more loan, and all these loans will direct to the financial earnings growth. So yeah, apart from that, these are the second page about what I mentioned just now. Yeah, I know it's a tier slide as well. From the view, more or less is the same. So from this budget, as you can see, the government don't have a very direct impact to all these sectors. Well, one thing that I want to especially mention here is the plantation. So unlike last time, the plantation, due to the the foreign labor issue, due to a lot of macro headwinds, our plantation companies, unfortunately, they couldn't enjoy the benefits of the soaring crude oil prices last time, because the FFB yield has been lowering down, and also the unfriendly weather. Well, this time around, we see that the government is giving a plantation matching grants and also the tax incentives for the plantation companies to improve the automation progress. So as you know that the foreign labor has always been an issue, especially for this kind of industrial related companies. So we believe that in the future, our government will very focus on this kind of automation incentives. While on the other hand, for the transport and rich industries, which are very dependable on the consumption growth. You know that China, they just announced their reopening, and also with Malaysia normalizing economy, we believe that in the near future we'll see some growth on this sector. Well, last but not the least, is it just a very quick recap on what has happened and what are our insights of this budget 2023. So if you want to know more, feel free to post in this Q&A session. If there is any burning question, definitely I will show to my colleague Alvin. And please let me please let me know if I do have any question. And also stay tuned to our Q&A, and because we will post it the QR code, which is our part of our giveaway activities. Yep, so let's move to the Q&A session. Wow.
Accident, yeah.
Okay, so the Q&A session, I saw there are some of the burning questions, so I will straight away direct to my colleague Alvin because I want to escape from that. Well, let's see. Wow, a lot of burning questions. Okay, so for the first question, I know that there are a lot of people concerning about their mortgage loan because of rising OPR rate. So our OPR rate nowadays is located at 2.75%. Last time the MPC has just announced they have a pause for that. And moving forward, what are your outlook for the OPR rate?
Okay, so for the OPR rate, let me show. I remember I prepared a slide for that. So so wait a while. Okay, and this slide. Okay, so for the Malaysia OPR rate, right, we do not expect a very sudden, unexpected move in the interest rate by the Bank Negara Malaysia, given the resilient domestic economy. This is because from the latest GDP announced by latest GDP release for the third quarter of 2022, Malaysia's GDP is at around 14.3% year-over-year growth, and it's very impressive. And for the total 3 quarters of 2022, it will be around 9.2%, if I'm not mistaken, year-over-year growth. And then so it has already set to surpass the government's target of 6 to 7% of GDP growth for the year. And then I believe that Kevin already mentioned the government's target this year would be around 4.5% GDP growth, and it is still very impressive considering coming after a more than 7% GDP growth in 2022. So next, right, we think that with recent leading economic indicators such as the Malaysia Leading Economic Index as well as the Industrial Index continues to paint a very resilient macro picture for the Malaysian economy. And then next, the other important factor that we will look into was the Malaysia inflation rate, because for the Bank Negara Malaysia, when they are deciding on their monetary policy, right, they look into the inflation rate, next the domestic economy, the GDP of the country. Unlike like countries like US, right, they focuses more onto the inflation rate as well as the labor market. So for Malaysia, right, the inflation rate actually we have recorded consecutive periods of this inflation rate after hitting its peak at around August in 2022. So it has come down considerably already. So next thing is that with the end of the King Dollar era, right, we think that this will put more benefit. This will benefit more towards the Malaysia economy because of because of the first thing that why the government decided to the Bank Negara decided to rise its rates at the first place is because of even if our inflation rate at that time wasn't as scary as US was, and also our GDP were quite strong at that time, but we still decided to raise our OPR rate is because of they wanted to protect the domestic currency, which is the Malaysian ringgit. Because when the US rises rates, right, this will cause a lot of their interest rate, right, this will cause a lot of funds move away from Malaysia to the US, because they are considered to be as very low country risk already. So the Bank Negara Malaysia raises its rate in order to try to support the Malaysian ringgit from further depreciating. So now when we see from this chart over here, it can show that first on your left hand side, you can see that the dollar, the DXY index, which is the United States dollar index, is down 8.15% from its peak already, while the USD and Malaysia cross rate is down around 6.5% already. So we think that, well, with this will become less concerning already. So we think that with the end of the King Dollar era, and then with the strong domestic economy, as well as inflation rate coming down already, we think that this will provide the Bank Negara Malaysia a leeway to further adjust its monetary accommodation and to provide support to the post-pandemic recovery. So in FSM1, we actually expect our OPR rate to be to rise at least one more time with 25 basis points to hit around 3% terminal rate in the first half of 2023. So yeah, thank you.
Well, apart from that, I do notice that there are another question, which you know that Malaysia, a 10-year yield, currently they are offering a 10.5%, while the US or other developed countries, they are actually offering a much more higher yields. So what is the reason that give you that you think local fixed income market is still attractive for you?
Okay, we think that, undeniably, there are other countries offering very, very attractive rates that may go up to maybe 5 to maybe 6, 7, or maybe more than 10% for some of the higher bonds. But we think that it is still important to include Malaysia bonds in your portfolio because of the stability that it provides. As I mentioned earlier, from earlier chart, you can see that despite all of the market volatility in 2022, Malaysia bonds remain very, very resilient throughout the entire year. So the other thing that we think that the Malaysia bond actually deserve a place in your portfolio is because of this. You need to take into account the currency aspect also from the currency aspects, because when we buy US bonds, right, if they're offering higher yields and we decided to buy US bonds, we need to convert our Malaysian ringgit to US bonds. So if the bond started to do good and then yields are falling, means that the Malaysian ringgit is actually when the Malaysian ringgit is actually rising against the US dollar, this will actually reduces your total income even if you are investing in US with higher yields already. So next thing is also that we need to consider that when the bond price, when US hikes its rates again, this will cause yields to grow even further. So this will when you invest in the US bonds, right, this will affect your bond prices also. So these are some of the major concerns that you need to think when you're investing in other foreign bonds. So we think that Malaysia deserves a place in your portfolio because of the stability that it provides to your existing portfolio. Yep. So I hope that answers your question.
Yeah. To recap his presentation, yeah, for sure that there are a lot of opportunities out there, but do not deny the fact that Malaysia fixed income are still offering a very, very good opportunity for you. Well, when we talk about fixed income, I do see a new question here. Yeah, I'm gonna catch you again, Alvin. So okay. What if just now, based on the assumption, you think that your USD has already peaked earlier, but what if the Fed still hike the interest rate this year? Does BNM need to follow the pace of a Fed's rate?
We think that even if let's say if the Fed continues its hawkish tone, yes, definitely, the Bank Negara will think to also follow the Fed's footstep because they want to protect our domestic currency. If our domestic currency depreciated heavily against the US dollar, then we would definitely choose to follow the Fed's footstep. But let me bring back to the chart. But we think that yes, Definitely, we think that, but still, it is an opportunity to invest in the local fixed income market because we think that yields have already priced in sufficient rate hikes. So, as I mentioned earlier, this chart shows that our yields have gotten the spreads between the yield as well as the OPR rate has widened significantly, and now at the current yields that we are trading now, it's actually at around when we compare it to the past, right? It is when around the OPR rate is at around 3 to 3.25%. So currently our OPR rate is actually only in 2.75%. So this gap provides the Malaysian Bank Negara Malaysia a leeway to increase their rates enough by 225 or even 50 basis point help without affecting heavily onto the government bond yields. So we don't expect, like, even if the Fed hikes rates aggressively and then the Malaysia Bank Negara Malaysia follow its footsteps, we do not expect bond prices to like slump heavily. Yep. So that's all. I hope that answers your questions.
Well, actually, it's not my question. It's from all.
Yeah.
Okay. Well, for the next question is talking about equity. I'll just read it out. Here. So, when can see the estimate improvement on Malaysia equity performance fund based on this budget? Well, personal opinion. So, if you ask me, when can we expect a good performance of KLCI? You know, KLCI has been very underappreciated throughout the years because relatively compared to the developed markets, compared to even some of the big boys from the emerging market like India, China, Brazil, actually Malaysia, we are a relatively smaller market. That's why we are easily gonna be impacted by all the macro development. You know, last year, Russia-Ukraine war, China lockdown, and also inflation and the Fed's rate, a lot of bad things happen. But what are the performance of APN KLCI? We delivered a very, very small drawdown compared to the other developed countries that probably give you a double-digit losses. So why does it happen? Because Malaysia, we are comprised of a lot of value plays, banks, plantation. So for the banks company, right? Especially you see that in the past few days, a lot of banks company have already released their fourth quarter result. Maybank, RHB, also and Public Bank. So based on my study from all these quarter report, actually, yeah, as widely expected, because of the Bank Negara Malaysia, they have hiked their interest rate, and it will result in the expansion of a net interest margin of the banks. And also, the normalizing economy will result in a better asset quality of the banks. So typically, they will have a lower provision. So when we think that the banks will have a very favorable fundamental, and they already have the fundamentals, so they just need a catalyst to boost the share price to go up. So at this juncture, banks, as known as a defensive play, as known as a value play, it might be less attractive compared to the tech play out there. But definitely, if you look at the long-term play, I will give you an answer, which is I believe that the fundamentals of banks hasn't really reflected on the share prices. Why? Because of investors out there, because of rising bond yield, they think that the dividend yield provided by banks is not that lucrative. So that's why they switch to the bond yield. But you know that the bond yield has always been a cycle. When the macro economy is performing better, definitely this kind of value plays, they will enjoy catalyst from there, and that's the tailwind that we are always expecting. So yeah, talking about equities, I do notice that another question, which sector in Malaysia we can consider to invest with this new budget. So one of the examples he gave is construction sector. Well, actually, on my previous presentation, I've already give you a very, very brief explanation on why we think that construction is the biggest winner of this one. So if you want to invest in construction sector, personally, I would suggest you to have a look at East Malaysia play. So what are East Malaysia companies like CMS, or maybe you can take a look at some of the construction sector that focus on the South Malaysia, which is around Johor area, like UAM, like IWCT, so these kind of companies. So just a disclaimer, this is not any investment advice. That this company is just an illustration that I think that probably would benefit from higher development expenditure. Well, on the other hand, we think that actually the smaller construction player will benefit more from this construction sector. Why? Because even if the government they already announced they want to review the budget for MRT3 from 5 billion, and they are targeting to narrow it to 4.5 billion. So if they really implement it, who are the one who hurt the most? Probably are those large players. On the other hand, the government has already announced probably 1,000 times they want to boost all these social infrastructure. They want to build these highways. They want to build railways. Especially if they want to develop East Malaysia, because there are a lot of support from there. So if they want to develop all these area, yeah, definitely the smaller players will benefit from these tailwinds. So yeah, if you ask me which sector in Malaysia we can consider to invest in this new budget, yeah, definitely I will tell you construction sector is one of the biggest beneficiary from this budget. Yeah. After that, let me see, is there any question about this? Yeah, Alvin, so just now you had mentioned about a lot of things about fixed income. So if investors, they would like to invest in Malaysia fixed income, how and where are the opportunities are there?
Okay, for Malaysia fixed income, right, at this current juncture, we continue to advocate short to medium term fixed income Malaysia bonds for investors to take advantage of the rising interest rate environment, and on the same time, while taking on a rather limited risk, as we think that most of the hawkishness has already been priced in in the current yields already. So let me pull out a chart. So from this chart, you can see that why do we go towards for more higher risk appetite investors, they can definitely consider to go into the higher yields one, which is the long-term bonds. But why do we like the mid to short term is because of when you look at this chart on your left hand side, right, this shows the yield curve of the Malaysia government securities, and the blue line represents the end of the year for 2022, and the orange line represents the beginning of the year for 2022. So you can see there's a significant changes where the yield curve actually changes for a steeper one towards a more flatter ones. This means that the lower end one actually moves more than the longer end one. So in terms of yield, we think that the shorter mid to short term bonds is actually offering more attractive opportunities for investors to invest in. But then if we look at the credit rating, for credit rating, right, we prefer the lower end credit rating, which is the single A, because if you look at the chart on your right hand side, right, the blue lines, which represents the Malaysia government securities and triple A's, as well as the orange line, which represents double A, is trading the yields are trading very, very closely with each other. But if you go one level lower, which is the single A's, the yields have actually, the spread is gone much bigger. So that's the opportunity to invest in. Why do we prefer the single A's more than the triple B's? Triple B's also, they are trading much more higher, but then they are actually taking in more risk, more credit risk compared to the single A's. So we think that for investors who seek opportunity to invest in the Malaysia bond market, we would like to recommend corporate bonds with a low, mid to low duration, and also at a lower end credit rating. So yes, so I hope that answer your question.
Yeah, I mean, we want to recap again. So in conclusion, you are thinking that which duration are better, short duration or long duration?
The mid to short duration represents a very good opportunity to invest in currently.
Okay, how about credit rating?
For credit rating, we advocate the lower end credit rating, which is the single A's.
Yeah, so hope Alvin answer for your question, because I've seen that quite a lot of Q&A are asking about what are our recommended duration and also the credit rating. So for the next question, I do see that another question for equities. So someone is asking about what is the best team for 2023 in KLCI? Well, if you ask me what is the best team in KLCI, I would say that perhaps this is a time to invest in this underappreciated market. Why I say so, KLCI throughout the years, it's always been it's always been not a favorable, especially for the foreign players out there. But nowadays, with a lot of uncertainties out there, especially in US, people are still worrying about how severe the recession is, and also people are still figuring out how the Fed's gonna position themselves amidst this kind of situation. On the other hand, China, they just announced their COVID-19 policy. They announced their COVID-19 policies, which they totally abolished the zero COVID-19 policy. Well, definitely the market has always been reacted positively towards the news, and as you can see that China A share and also a H share has enjoyed a very good rally in the past month. While on the other hand, you need to note that last year, when the market are bad, when a lot of supply chain disruptions, when a lot of uncertainties out there, where does the fund flow to? Which is ASEAN market. Because ASEAN, Indonesia, Malaysia, we are famous with commodity exporters. Singapore, they are famous with their very resilient kind of economy. Thailand, one of tourist favorite places. So this ASEAN market, we think that it's gonna be a very strong tailwind moving ahead, especially when you see that the US and China geopolitical tension, and most of the companies they are looking for some place to relocate their supply chain to avoid to minimize all these potential conflict from US and China. So that's why we think that ASEAN is a good place to invest. And of course, Malaysia, as a relatively stable countries in the ASEAN region, we do think that this will eventually benefit KLCI in the future. Well, also I do see another question which asking me about the plantation sector, which has already dived long to bottom and the demand is still higher. Well, actually last year, as I already mentioned, the plantation, the share prices showing a divergence compared to the CPO prices is mainly because of the FFB. Last year, although due to the macro development, the CPO prices spiked up a lot last year, but too bad our weather condition, our foreign labor policies, and also some of the inventory issue that dragging our plantation companies to come up with the supply. So that's why you can see that although I do not deny the fact that some of the plantation companies, they have delivered a very good earnings last year, but if you look at a lot of analysts out there, they are giving a negative earnings forecast for plantation. So why? Firstly, they think that the CPO price is likely to maintain at this stage, so it will be a negative impact for those plantation companies, especially like they really enjoy a very superior profit in the last year. So definitely this year they will show earnings year-over-year growth. And on the other hand, you can't just rely on the CPO price to decide what's the earnings forecast for plantation, because ultimately the CPO price is not only reflecting the supply and demand, it's an index, it's a futures that traded by all the traders out there, and it might affected by the market sentiment. So that's why when it comes to plantation, definitely supply and demand is one of the crucial play, but also you need to look at how much the production can come from Malaysia. Also, last but not the least, which I think that one of the biggest headwinds for plantation is ESG consideration. This time around, the government has announced I think it's double-digit millions to assist plantation companies in all these anti-plantation activities, especially in the DM side, like EU, like US. They want to boost one of our key export products. So we, at this juncture, the plantation, I know, is still on the shore, but we believe that in the near future, when the automation come in, when more catalysts come in, we do hope that the plantation will have a better performance moving ahead. Well, for the next question, let's talk about equities. So I want to direct this question to Alvin. So, okay, so it is quite a straightforward question. Is there any hope for a semiconductor player in Malaysia?
We think that in terms of the budget, right, there is not, I would say, like very directly impact towards the the semiconductor players, but there's one thing that will affect directly towards the semiconductor players is the subsidies allocated. Like the government has announced that there will be they will remain the electricity subsidies for the SMEs as well as mid to low income household, but they will reduce the subsidies towards for the high income households and bigger companies. So lower electricity subsidies will definitely increase some of the costs for the local semiconductor players, that because they are most of them were manufacturing companies. So in terms of, let's say, semiconductor, is there a hope? We think that definitely we will until now we are quite remain slightly optimistic on the semiconductors players in Malaysia, because of first, we think that looking at the semiconductor down cycle, right, we are actually somehow near to the bottom already. I wouldn't say that we are already at the bottom, but we are somehow nearer to the bottom already. So, but with all of the companies facing rising costs as well as rising inventory, although they will still be, it won't like suddenly miraculously disappear, this issue. They will still be there, but they will somehow be getting improvement. We'll start to see some improvement already. So within the semiconductor space, we like the EMS, because the electronic manufacturing services players, because with one of the huge player, they got kicked out because of some of the termination of contract from their huge customer. So we think that with the consolidation of the revenue already, so we think that some of the large EMS player will definitely be benefited. And then also, as well as the China and US tensions, we also lure some more contracts towards the Malaysia EMS players as well. So the next thing is, when we look into the OSAT place, we think that yes, they will continue to face some pressure from the slower global demand as well as higher inventory costs. So as for the software side, we think we will maintain somehow neutral on it. So basically, for semiconductor side, we are slightly optimistic, but especially in the EMS sector.
Yeah, so I know that there are a lot of questions out there, but due to time constraint, probably I can just answer the last question. So which is, let me see what are the interesting last question here. Okay, well, it's a very interesting question. I want to direct this question again to Alvin.
Okay.
So seeing that the USD may not be the worst reserve currency in the future, would it be wise to invest some gold to hedge against the uncertainties?
Okay, firstly, I won't say that USD will not be the world reserve currency in the sorry, let me find that question. So it's not to say that USD wouldn't be that the world reserve currency already, because we think that the US dollar wouldn't go down its throne without a fight. So currently, although the US dollar is off its peak already, but we don't see any currency replacing the US dollar soon enough. So, and definitely gold is a very attractive commodity to invest in, but we don't think that it will replace the US dollar's position currently as the world's most important reserves. So, but investors do need to have this thing in their mind, is that the risk of investing in gold. First, if US dollar continues to appreciate, this will impact gold's value as well. The gold will face some depreciation in value. So as well as we think that the gold, due to their storage costs, they have high storage costs. We don't think that this will somehow put some pressure towards their growth as well. So we think that yes, it is good to have some golds, invest in some golds in your portfolio, to have this type of diversification because of their low correlation with the equities and bonds. So, but still, US dollar wouldn't likely to go off its throne without giving in a fight. So yeah, I hope that answer your question.
Yeah, thanks Alvin for all the insights. And last but not the least, Alvin, would you want to give all the audience some giveaway that how do they achieve this 100 ringgit?
Okay, so from here, in line with our 15 years anniversary, we will be glad to announce a join and win campaign, a giveaway, where you can stand a chance to win 100 ringgit Malaysia Touch and Go e-wallet credit for if you just basically simply need to join all of these 3 webinars as stated in the bracket there, and then do need to remember to use the same username as well as the same email when you are logging into or registering into the webinars. And then you need to also scan the QR code and fill in there will be a document, Google form, and fill up the Google form, and then you'll get a chance to win this 100 ringgit Touch and Go e-wallet credit. Yeah, so with that, do you have any conclusion for our today's sharing fireside chat?
Well, I know that it is a very urgent budget, and probably a lot of investors they're very frustrated about their performance because of the not really satisfying the market last year. So in 2023, we are expecting a similar volatility looking ahead. But what I want to advocate investors here is the only way for you to beat the market is to stay invested in the long term and believe that the earnings will eventually reflect the prices. So yeah, that's my conclusion. Do you have any other conclusion, Devin?
Not much from my side, but finally, I would like to say thank you all of you for joining us here, and we hope that this session has give you more insights as we share our thoughts on what we see moving the markets in the days and months ahead. So thank you all for joining us today, and we hope you have a good day. Thank you.
Thank you.